that I'd like to mention too, in my interview with Judy Shelton, I asked her some tough questions. And I said, what about the gold not being audited? And she says they always come up with these stupid excuses, too expensive and logistically challenging. And she's like, that's hogwash. We're the United States, spend a few $1,000,000 and get it audited. And that's what she would advise. And I asked her about revaluing gold, how Cynthia Loomis, she said she's a big fan of Cynthia Loomis, Senator Loomis from Wyoming, and an advocate for what she's talking about, revaluing gold. She didn't go out and fully say it, but she more or less said, yes, that is a strong possibility, and that they would issue, she believes, on July 4th, 2026, which is the 250-year anniversary, they will issue, Trump will issue 50-year treasuries pegged to gold. And then she said something very interesting as well. She said, and then I could see stable coins being issued backed by the 50-year treasury collared with gold. And this is a woman who could very well be in the Federal Reserve. She was an advisor to Trump. He wanted her to be the head of the Fed. She's very smart. And I think the bottom line is that when I look at everything I see all this talk of crypto and profit and greed and risk on, and the central banks are doubling down on their gold acquisition, hand over fist. And 45 million ounces of silver delivered off of COMEX, either through flat out delivery or exchange for physical in the month of December. Who's got that bread? Where's it going? So we're getting to a point where I think these countries, and they're going out of their way to hide it. Saudi Arabia got busted for not reporting it to the IMF. Sorry, we made a mistake. Well, the import-export numbers outed them. Same thing with China. A recent article just came out in Reuters the other day saying that they think that the numbers they've been buying are 10 times understated. 10 times! And that they have never stopped buying all along when they said they took those few months up. No, they didn't. They just were hiding it and buying it directly from the miners or buying it through the People's Liberation Army. So you see a concerted effort to hide the de-dollarization and to mask it. And after what the BIS did to the BRICS nations at the 12th hour by pulling out of Enbridge, saying we can't work with a country being sanctioned, forgetting that Russia was the R in BRICS, after 4 years of working with these countries to develop it, I don't blame them for being less than forthright. But the one thing that I see through all of this is that the central banks keep buying gold and possessing it, repatriating it. And when I hear someone like Judy Shelton say that's in our future, then I would simply say, especially for those retirees, if you've made a nice profit along the way, get the hell out. What do you got to lose? A lot more than you have to gain. And especially when markets are at all-time highs and the insiders are selling 6 to 1. What more do you need to know? And that would be my biggest piece of advice. And everyone is so infatuated with risk on. That's the exact time. If you were having a beer with Rick Rule right now, he'd say that's the exact time to move the other direction. And that's what a contrarian does. So one of these times, this broken clock of ours will be right. And even though gold was up 30% this year, it feels like it didn't do anything, right? Because we live in this instant gratification, triple your money in 3-week environment. That's going to hurt a lot of people because that's what they believe investing is. And my whole career, 35 years, says, no, that isn't what investing is. And no, this isn't different this time. I think there's just a lot to be cautious about, truly do.
What people should be thinking about and perhaps taking proactive steps to mitigate risks to their retirement. And we can talk about any different aspect of that. Some of the ones that come to mind include the banking system and bonds and the stock market volatility, etc.
Andy Schectman's insights resonate deeply in today's economic landscape. Gold and silver have been the ultimate hedge against uncertainty, and the narrative he presents underscores the urgency of considering precious metals as a cornerstone of financial security. With central banks worldwide ramping up their gold purchases and geopolitical tensions reshaping the global economy, it's clear we're at a pivotal juncture. Let's delve deeper into this compelling narrative. Central banks are doubling down on gold acquisitions, marking a historic shift in monetary strategy. The numbers don't lie. Massive volumes of gold are being repatriated and stockpiled. Schectman points out that nations like Saudi Arabia, China, and others are quietly amassing gold reserves while downplaying their purchases. Recent revelations suggest China's reported gold acquisitions may be understated by a factor of 10. Why such secrecy? The answer is simple. Gold is the ultimate counterweight to the dollar's declining hegemony. Saudi Arabia, for instance, was recently outed for underreporting its gold imports. Similarly, China has been accused of using its People's Liberation Army and state-backed entities to bypass traditional reporting mechanisms. These actions highlight a strategic de-dollarization effort by major economies. For everyday investors, this should be a wake-up call. If nations are hedging against the dollar with gold, shouldn't you? Schectman's interview with Judy Shelton offered critical insights into the potential future of gold-backed monetary systems. Shelton, a respected economist and advisor, speculated on the issuance of 50-year U.S. Treasury bonds pegged to gold, possibly by July 4th, 2026, America's 250th anniversary. This move would not only stabilize the U.S. financial system, but also restore global confidence in the dollar. Shelton also floated the idea of stablecoins backed by these gold-collared treasuries. Such a hybrid system could marry blockchain transparency with the enduring value of gold, creating a modern, credible monetary framework. This concept aligns with the broader trend of merging traditional assets with cutting-edge technology. Imagine a world where your savings are anchored by gold but accessible via digital wallets. This could become a reality sooner than we think. One alarming trend Schectman highlights is the stark contrast between insider selling and individual investor behavior. Corporate insiders, who often have the most accurate pulse on their company's futures, are selling stocks at a 6-to-1 ratio compared to buying. Giants like Jeff Bezos, Mark Zuckerberg, and executives at NVIDIA have offloaded billions of dollars in shares this year alone. Meanwhile, individual investors, driven by FOMO, fear of missing out, are still piling into overvalued equities. This imbalance should raise red flags. Historically, insider selling at such levels has preceded major market corrections. The lesson here? Don't ignore the signals from those in the know. Pivoting out of overvalued assets into safer havens, like short-duration treasuries or precious metals, could be a prudent move. Inflation remains a persistent threat, eroding the purchasing power of fiat currencies. Schectman offers a stark comparison. In 1974, a 400-ounce gold bar cost $14,000. Today, that same bar is worth over $1.2 million. Did gold become more valuable, or did the dollar lose its value? The answer is clear. Fiat currency inflation is relentless, and gold serves as a shield against its corrosive effects. As inflation accelerates, so does the appeal of gold and silver. These metals don't just retain value, they often outperform other assets in inflationary environments. With governments worldwide continuing to print money to fund ballooning deficits, the case for owning precious metals becomes even stronger. The geopolitical landscape adds another layer of complexity. Trade wars, sanctions, and shifting alliances create uncertainty that directly impacts global markets. For instance, Trump's proposal to impose tariffs on imported metals could further inflate prices and disrupt supply chains. Gold, however, thrives in such environments, offering stability amid chaos. The BRICS nations, as Schectman notes, are actively working to decouple from the dollar. Their moves to establish alternative payment systems and strengthen gold reserves are a testament to gold's enduring relevance. These developments signal a slow but steady erosion of dollar dominance, a trend that investors should not ignore.
So, what comes to top of mind for you with the incoming administration and the policies that we've been told are likely to be put in effect?
When I follow who's been buying gold, I look to the central banks. When I see what's going on in the stock market, I see the insiders selling at a 6-to-1 clip versus buying. In other words, corporate insiders are, for every one purchase, there's 6 sales. And you look at guys like Bezos, who sold $12.5 billion recently, Zuckerberg, who sold $2.5 billion worth of Meta. You look at the NVIDIA insiders selling over $2 billion worth of sales. This is all year to date, but just between Zuckerberg and Bezos alone, you're at $15 billion sold. And, if the economy was roaring and we would expect the stock market to continue on this massive train moving forward, you wouldn't see that happening. And so as corporate execs are cashing out, individual investors aren't. That's a premise that I would start with, that I would be very nervous. I think we can look at the bond market, which in and of itself is getting nervous as inflation concerns are again reemerging, and they really never left. I mean, the Fed pivoted, at 65, 70% away from their lofty target rate. Was making a joke about this the other day. You're taking a cross-country trip from California to New York, and you stop in Omaha and say, we're there. We're 70% of the way there, but that's okay. That's good enough. And the point of it is that they haven't signaled victory on inflation. They've waved the white flag on it. And we can see that happening as the 10-year Treasury keeps going higher. In fact, the 20-year Treasury, which is something we really don't talk about very often, eclipsed 5% here just the other day. That's a big deal. That's a problem. We're getting into that point where the economy is going to start to shake and rattle, and we're seeing that with all of the longer duration maturities, and so what does that mean for the economy? What does that mean for the bond market, for the ballooning U.S. debt? And what does it say about the flood of new Treasury securities that the government's going to have to sell? Who's going to buy them? Does that mean higher rates yet still? Are we in store for a yield curve control, which will again exacerbate inflation as we create money out of thin air by the Fed to buy the debt because no one else wants to buy the debt? And then you look at all of the metrics by which we gauge, are we heading into a recession, which would negatively impact stock portfolios and whatnot. And by every single metric, and then some, we're there. The reinversion or the uninversion of the yield curve, the Claudia Sam rule, the increase in money market holdings, which is up to over $7 trillion. All of these things have accurately predicted recessions in the past. And so if I were at that point where I'm very quickly going to be receiving money out of my retirement, I would not have a problem with pivoting. I would not have a problem with selling all of those stocks in my IRA that I made a lofty profit on. Get the hell out of them, just like the big money is doing, before something happens that forces you to get out. Get out now, and I would layer it into incredibly short duration treasuries. As crazy as that sounds to me, I don't know where else you go where you can feel safe and sleep well at night in a market by every single metric is classically and historically overvalued, and the insiders are bailing ship, and the long end of the bond market moving higher, where the banks who bet again that wouldn't happen are going to be on the wrong side of that bet, especially if rates really start to move higher, which I expect that they will.
Inflation is the silent enemy of wealth, eroding purchasing power year after year. As Andy Schectman points out, it's not that gold and silver increase in value, it's that the dollar loses its purchasing power. This principle has never been more relevant than it is today. Let's rewind to 1974. A 400-ounce gold bar cost $14,000. Fast forward to today, and that same bar costs over $1.2 million. Did the gold really become more valuable? No, the dollar simply became less valuable. Inflation is not just an economic phenomenon, it's a political tool. Governments use inflation to manage debt, but the cost is borne by the average citizen. When Schectman discusses the impact of inflation on retirees, it hits home. Imagine saving diligently for decades, only to find that your retirement fund buys a fraction of what you expected. This is why gold and silver are critical. They don't just retain value, they protect against the systemic risks of fiat currency. The bond market is sending clear signals of distress. Long-term yields are climbing, reflecting investors' concerns about inflation and mounting U.S. debt. The 10-year and 20-year treasuries recently crossed critical thresholds, indicating growing nervousness. These aren't just numbers on a chart, they represent a fundamental shift in investor sentiment. Higher bond yields make it more expensive for the government to service its debt. With a $31 trillion national debt, even small increases in interest rates translate to massive additional costs. This creates a vicious cycle. Higher rates lead to higher borrowing costs, which lead to more debt. At some point, the system becomes unsustainable. For individual investors, this is a wake-up call. Bonds, traditionally seen as safe havens, are increasingly risky. The solution? Diversify into assets that aren't tied to the performance of fiat currencies. Gold and silver offer a lifeboat in this stormy sea. The BRICS nations, Brazil, Russia, India, China, and South Africa, are rewriting the rules of global trade. By moving away from the dollar and creating alternative payment systems, they're challenging the status quo. Schectman emphasizes that this isn't just theoretical, it's happening in real time. Take BRICS Clear, a payment system that allows member nations to trade in their own currencies, bypassing the dollar entirely. This system could be a game changer, especially if it's backed by gold. The idea of using gold for net settlement among BRICS nations is gaining traction, and it's easy to see why. Gold is the ultimate neutral asset. No single country controls it, and its value is universally recognized. The implications for the US are profound. As more countries adopt gold-backed systems, the dollar's role as the world's reserve currency diminishes. This shift won't happen overnight, but the groundwork is being laid. For investors, this is another reason to consider precious metals. As the dollar's dominance wanes, gold and silver will shine even brighter. When corporate insiders start selling their shares in droves, it's time to pay attention. Schectman highlights alarming statistics. For every stock purchased by an insider, there are 6 sales. Giants like Jeff Bezos and Mark Zuckerberg have collectively sold billions in shares, signaling a lack of confidence in the market's future. Contrast this with individual investors who are still pouring money into overvalued stocks. This disconnect is troubling. Historically, insider selling at these levels has preceded major market corrections. The lesson is clear. Follow the money. If those with the most information about their companies are selling, why would you hold? For retirees and risk-averse investors, this is the time to pivot. Moving into safer assets like short-term treasuries or precious metals can provide stability while preserving capital. The goal isn't to chase returns, it's to protect what you've already earned. One of the most intriguing ideas Schectman discusses is the potential revaluation of gold. Judy Shelton, a respected economist and advisor, suggests that the U.S. could issue 50-year Treasury bonds pegged to gold. This would stabilize the financial system while restoring global confidence in the dollar. Revaluing gold isn't without precedent. In 1933, President Roosevelt revalued gold to combat the Great Depression. Today, a similar move could help address the U.S. debt crisis. By significantly increasing the price of gold, the government could offset its liabilities and stabilize its balance sheet. For individual investors, this underscores the importance of holding physical gold. In a revaluation scenario, gold's price could skyrocket, offering significant returns. More importantly, it would protect against the devaluation of fiat currencies. While gold often takes the spotlight, silver is equally compelling. Its industrial applications make it indispensable in sectors like renewable energy and electronics. At the same time, its monetary properties make it a reliable store of value. The current gold-to-silver ratio suggests that silver is undervalued. Historically, this ratio has been much lower, indicating significant upside potential for silver. As demand for silver grows, particularly for industrial uses, prices are likely to rise. Moreover, the supply of above-ground silver stockpiles is dwindling. Industrial consumers have relied on these stockpiles to meet demand, but this strategy is unsustainable. Once these reserves are depleted, the market will face a supply crunch, driving prices higher. For investors, this represents a unique opportunity to capitalize on silver's dual role as an industrial and monetary asset. Blockchain technology could play a pivotal role in the future of money. Schectman discusses the possibility of stablecoins backed by gold-collared treasuries. This hybrid system would combine the stability of gold with the transparency and efficiency of blockchain. Such a system would address many of the flaws in today's monetary system. It would provide a stable store of value, reduce reliance on fiat currencies, and offer a secure, transparent platform for transactions. For investors, this underscores the importance of staying informed about technological advancements in the financial sector. In light of these developments, what should you do? Here's a roadmap. Diversify into precious metals. Allocate a portion of your portfolio to physical gold and silver. These assets provide stability and protection against inflation and currency devaluation. Avoid overvalued assets. Insider selling and market overvaluation signal potential corrections. Consider reducing exposure to high-risk equities. Focus on physical ownership. ETFs and other paper-based gold investments carry counterparty risk. Physical ownership ensures direct control over your assets. Monitor geopolitical trends. Stay informed about global developments, particularly in the BRICS nations, and their moves toward de-dollarization. Prepare for volatility. The road ahead is uncertain, but a diversified portfolio with a focus on precious metals can help navigate the challenges. Leverage professional guidance. Consider consulting with a financial advisor who specializes in precious metals. Their expertise can help you make informed decisions. Investing in gold and silver isn't just about returns, it's about peace of mind. Knowing that your wealth is protected against inflation, market volatility, and geopolitical risks is invaluable. Schectman's advice to retirees is particularly poignant. Don't wait for a crisis to act. By taking proactive steps now, you can safeguard your financial future. The financial landscape is fraught with challenges, but also ripe with opportunities. Gold and silver offer a timeless solution to the complexities of modern markets. They are not just assets. They are shields against uncertainty, tools for wealth preservation, and bridges to a more stable financial future. For investors, the message is clear. Act decisively and align your portfolio with the enduring value of precious metals. The choices you make today will determine your financial resilience in the years to come. Whether it's navigating inflation, geopolitical tensions, or a potential debt restructuring, gold and silver are your steadfast allies in an ever-changing world. As Schectman aptly puts it, one of these times this broken clock of ours will be right. Let's ensure that when that time comes, you're prepared to weather the storm and thrive in the aftermath.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.